Hello, David Moore at Equity Advantage, IRA Advantage, and I'm pleased to have my guest Art Scevola here with me. And once again, we're going to be talking about life policies and contracts. The title is The Good, the Bad, and the Ugly, and we're on the ugly section. And I guess, sometimes you got to look at it and say sometimes the good can be ugly too. So Art, you just mentioned something I think that's very important, something people typically don't think about when we talk about life policies, but tell us what else you got going on with longer lives and people ending up maybe places they don't necessarily like to be, but
right.
How are they taken care of?
Yeah, I don't want to be the Grinch that stole Christmas, because you can go to the movies for that.
Yeah.
The reality is there are a lot of time bombs ticking out there under the banner of long-term care insurance. Long-term care has been promoted for years and years as a solution if I lose the capacity, right? We'll just cut to the chase, and everybody probably knows what's required in order to collect long-term care. The sad part of the problem is that the carrier producing groups have consolidated into 4 or 5 carriers in the United States that have that risk profile that allows them to be able to continue to be holders of long-term care commitments, and the premiums are going up every single year, it appears, and maybe for the foreseeable future. One alternative to that ugliness, and I think everybody would agree, if there's no end in sight to the premium increase, if I don't get into a claim, that money is all just down the drain for the most part, like term insurance money that I never died in time to have collected by my beneficiary. So long-term care alternatives have arisen, and they're called hybrids. Now, what are hybrids? Hybrids are policies that actually can be invested in, typically from CDs and bonds that I already have, in order to put into a single premium, typically one where there is access to all of the money, including the face value down to 80 or 90 or maybe percent of the overall cash.
Wow.
For long-term care claims. And the claims are tied to the activities of daily living, typically of any long-term care, typically a little more liberal of a requirement than is true of the pure long-term care policy. So let's, as an example, if I had a $100,000 CD and I was 68 years old and I got a $140,000 single premium policy by just moving that $100,000 under that, then I could have access to $140,000 for long-term care subsequent to making sure I qualified, and be able to draw that out of an amount that was greater than I actually invested right from the get-go.
Wow.
Now, is that a full solution? Chances are not necessarily, but it may be a lot better than paying $5,000, $6,000, $7,000 a year and up for an indefinite period of time with an indefinite ceiling for long-term care insurance, which may or may not result in the full commitment of claims. So we're seeing a lot more hybrids. All the major carriers that we work with through my brokerage do carry a product for this area. Long-term care, typically single premium, not a lot of death benefit associated, but enough to where it makes it attractive for somebody 55 or older to be able to put that in place.
So Art, you were talking like that 5,000 to 7,000 a month burn rate, and it sort of made me think of something else we were talking about earlier, and you were talking about, let's say, you stated the bleed out of a life policy. That's one of those other issues. I'll throw it in the bad section here. Mm-hmm. You mind just what you meant by, just a brief description of what you meant by that?
There becomes a mathematical point at which a life insurance policy, if it has gone down in value to such a degree, normally through either over borrowing or a very small amount of premium just to maintain it up until you get to a certain point, becomes essentially a time bomb that's going to lapse. And when it lapses, there's no value for anybody. So what we find ourselves trying to do is to catch that before that event occurs. Be the charity the owner, the individual the owner, the trust the owner. And it requires a couple of steps on the part of you, the consumer, to say, let me look at an in-force illustration based on the current rates and tell me back through the mathematics of the illustration process, is this policy going to be supportable at the rate I've assumed that I would continue to pay? Will I need to pay more? Or if I do nothing, will the policy die before I do? Yeah. And that becomes an issue that is an economic question that needs to be dealt with as soon as it can be, because we're seeing the trend line being more of those being subject to tailing off, as you said.
So I always joke when we're talking about exchanging and other issues that if you've got, it's one thing to have good tax counsel, it's another to actually use them. So
right.
So I jokingly tell people, your tax people like to hear from you before April 14th, right? So
right.
In this situation, it sounds to me, it's like anything else. You've invested money in something. You've got this thing now. You really got to look at it and talk to professionals in your life to make sure you're doing
right.
what's right for you at a given period
Absolutely.
of time.
Absolutely.
So, and don't ever look at these things as being worthless or just doing something without talking to the experts that can
That's
actually
the
give you
ugliest
some
of all,
yes.
right? Is to sit on your hands and not ever go out and seek that kind of professional coordination.
And we all love to deal with insurance. We all love to go through all that stuff and open up our lives. So
right.
Once again, David Moore with Art Scevola. Thank you for joining
Thank
us,
you.
and we'll be back in a minute.
Thanks, David.
Thank you.